Welcome to the deep dive. Today we're cutting through the jargon and taking a deep dive into Know Your Customer, or KYC. Now, if you're thinking dry regulations, maybe think again. This is really fundamental to building trust, stability in our financial world. It touches everything.
It really does. KYC has evolved so much. Well, it's no longer just a procedural thing, a box-ticking exercise. It's now a critical part of risk management, ethical business conduct, and really safeguarding the whole global financial system from fraud, money laundering, even terrorist financing. It's foundational.
Right, foundational integrity, and that's exactly what we want to unpack today. Our mission is to quickly distill the strategic value of KYC, its core parts, how tech is changing it, and what it all means for you. Okay, let's unpack this. So basically, KYC is about verifying who a client is and, well, understanding their potential risk. It definitely started, as you'd guess, in banking, mainly to fight financial crime. But what's really striking is how far it's spread. Insurance, legal services, crypto, it's almost everywhere now.
Mm-hmm. And what's often missed, I think, is that KYC isn't just about stopping bad actors. It actually enables good business. By creating transparency, it maybe ironically, makes legitimate deals faster, more secure, it builds confidence, it protects businesses, sure, but crucially, it protects you, the individual, from losses and reputational harm. It lets commerce flow.
Okay, so if it's this essential foundation, how does it actually work? It's not just one check, right? It's more like a journey.
Exactly. A journey is a good way to put it. It usually kicks off with the Customer Identification Program, or CIP. That's the initial ID check, think government IDs, proof of address, that sort of thing.
The basics.
The basics. But then it goes deeper with Customer Due Diligence, CDD. This is where the institution sizes up the risk profile.
And that means really getting to grips with the customer's business, their activities.
Yeah.
Especially if it's a company.
Absolutely. Understanding the nature of their business, identifying who the ultimate beneficial owners are.
Ah, the beneficial owners. Getting behind the corporate veil.
Exactly. Preventing shell companies hiding illicit funds. Seeing who really controls things. And CDD isn't one size fits all. There's simplified, SDD for low risk, standard, and then enhanced due diligence, EDD.
EDD is for the higher risk cases.
Right, like politically exposed persons, EPs, where there might be a higher risk of corruption because of their influence. And crucially, like you said, it's not a one-off. Ongoing monitoring is key. Watching for unusual activity, changes in behavior over time.
So this whole structure feeds into a risk-based approach, yeah. Focusing effort where it's most needed.
Precisely. It allows institutions to tailor their efforts. You focus your resources where the threats seem greatest, connects to the bigger picture of efficiency too.
Okay, that framework makes sense. Now let's talk technology because, well, this is where it gets really interesting.
Oh, it absolutely has. Technology has transformed KYC. We're seeing AI and machine learning getting incredibly good at spotting anomalies, flagging risks much faster than humans could.
And biometrics?
Biometrics too, fingerprint scans, facial recognition. They offer secure ID checks that are actually pretty user-friendly now. And then there's blockchain, which holds promise for creating tamper-proof, maybe even decentralized identity records down the line.
And eKYC for faster onboarding.
Yep. eKYC streamlines digital onboarding significantly. Think of India's Aadhaar system, huge impact there, plus RegTech solutions automating compliance tasks.
Sounds almost like a perfect solution, but I assume there are challenges, pitfalls.
Oh, definitely. Data quality is a big one. Getting accurate, reliable data isn't always easy. Cost is another factor. These systems aren't cheap to implement and run. And there's always the potential for customer friction. If the process is clunky, people get frustrated.
Right. And how does it differ across industries? Banking must be different from, say, crypto.
Hugely different. Banking regs are incredibly stringent, as you'd expect. Insurance focuses more on verifying policyholders, beneficiaries, legal and accounting firms. They often deal with complex corporate structures, so unmasking beneficial ownership is critical for them. And crypto and fintech, well, that's a whole different challenge. It's fast-paced, global, and involves this constant balancing act between giving users privacy and meeting compliance demands.
So what does this all mean then? Looking beyond just compliance, what are the bigger ethical questions or future directions?
Well, data privacy is huge. You have regulations like GDPR, CCPA. How do you collect necessary data without infringing on privacy rights? And there's the inclusion versus exclusion debate. We need to ensure KYC doesn't accidentally lock vulnerable people out of the financial system.
That's a really important point.
It is. And we also need to watch for bias in the automated systems, the AI, regular audits are crucial there. Looking forward, there's a push for global regulatory harmonization, making rules more consistent across borders. That would help. Decentralized digital identity is a fascinating area, could give you more control over your own data.
Oh, interesting.
And we're even seeing ESG factors, environmental, social governance, starting to be talked about in the context of KYC risk assessment. So it's becoming much broader.
Wow. So KYC is really evolving into this strategic function tied into ethics and even wider corporate responsibility.
Absolutely. It's far more than just a regulatory hurdle now. It's a cornerstone for trust, for safeguarding the economy.
And for professionals in this space.
Continuous learning is vital. This field changes so fast. Staying current is key to being an effective guardian of, institutional integrity.
So, a final thought for you, our listener. How might future